Hello and welcome to another episode of the Investor Financing Podcast. You're in for a real treat today. We're going to talk all about multifamily lending, debt, equity, structured finance, syndicating loans, all the stuff that is going to interest you as real estate investors. And I know it's going to be an exciting episode. So please welcome Roddrick Jones of Party Capital Markets. Welcome to the show. Thanks for joining us from Atlanta.
No problem. Thanks for having me. I'm happy to be here.
All right. So before we went live, I was digging in on some of your background. So if we can kind of rewind to your real estate career, you got into real estate and you actually got into the syndication world first, and then you got into the lending world. Can you kind of talk us through how you got your start in real estate, what drew you into real estate, and then what you're doing today with your business?
Yeah. So I'll give you the long story short version of it. So I got started in real estate by wholesaling initially. I got started in residential wholesaling real estate. I was looking at all the commercial guys, doing commercial deals, and they're like, "You're working too hard, look in the commercial." So I'm like, okay, I look in the commercial. And so I came up with the idea to buy 100 units all over Atlanta. And then I realized that it's going to take me a long time to buy 100 units all over Atlanta. Then I got to travel to all those places. Then I realized that I can get 100 units in one place. Then that's when I found out about multifamily. I'm like, I can get 100 doors in one place and I only got to drive to one building. So I'm like, okay, this is what I want to do. So I met a guy online. He told me that, if I want to do multifamily, I have to stop doing wholesaling and I have to stop doing residential altogether and just dive in on multifamily. And so that's what I did. That day I said, I'm done with wholesaling, I'm done with residential, all in on multi. So now I dove all in on multi, started raising capital for multifamily deals through syndication, raising money from accredited investors. We were doing 100 units up across the Southeast, and we were raising equity checks anywhere from, I would say, $1 million to $4.2 million. That was like our real sweet spot of raising. And then for my first deal, it was a 485 unit deal in Houston, Texas. So a group of syndicators hit me up and was like, "Hey, we want you to come in, do this deal with us." I'm like, okay, I got the money. And so I went to raise money from my accredited investor database. I was in charge of raising, I want to say 600,000. And I came back and I raised absolutely zero. And I fell flat on my face. And I was so mad because I'm like, I talked to all these people, they said they would commit to me 50,000, 20,000, 100,000 checks. I go and collect the checks and I have no investors. And then I realized that I can't run a business like this. I got to figure out how to make this work. So then I shifted into the institutional space where it's, they have the money. It's just, does it fit the criteria? Does it fit the box? And if it fits the box, then the money unlocks. And so I'm like, okay, institutions have the money. Now they just need the deals and the opportunities. So I can take the same model instead of raising from accredited investors. I can just do it with institutions, and I don't need a lot of institutions to get it done. I can just do one or two and call it a day. And so I was doing that, but I skipped the part. So I was doing all that. And the reason I got into the institutional realm is because, my accredited investors couldn't raise on the first model. But while, doing syndication, I realized that I really didn't like the running and owner operating of running the properties day to day. I really like the capital stack. I like how the dollar works. I like how you can break it down, put it back together, and it can be in a different way once you put it back together, and how you can generate investor returns from, just having capital and deploying capital. And once I realized I could do that, that's when I said, okay, I no longer want to be a owner operator. I want to be an allocator, and I just want to put structures together and place it in the right hands and watch it grow.
That's awesome. So can you walk me through, or walk everybody that's going to watch this in the future, walk us through? So you might get a call from a multifamily syndicator and they've got a deal under contract now. And maybe it's a bridge loan. They're going to get in senior debt. It's going to be a bridge. They're doing a value add, but now they got to raise 20% or total project cost, or whatever that dollar amount is. So they call on the heavy guns, right? And that's where you kind of come in. And now, if I'm hearing you correctly, you can go out and you can actually raise funds to syndicate the bridge loan, but also you can raise funds for the equity piece. And,
correct.
And so are you mostly now syndicating, allocating the money through institutional capital sources? versus like the individual mom and pop accredited investor?
Yes, that's correct. So I'm allocating from institutional sources into sponsors deals directly. And it's structured in a, so what I do is I raise funds specific. It's called a deal by deal fund, also known as a syndication, but it's a deal specific fund or a special purpose fund. And what we do is raise funds specifically for that deal. And then we take those funds and we invest it into the deal, into that sponsor's deal. And then what this does over time, as we invest those specified funds into that sponsored deal, if the sponsor does really good, then, you know, we can go out and raise a flagship fund and we just put a pool of capital with you. And it's not on a deal by deal basis. It's you've, you know, done good on these past 5 deals. You've proven the model. Let's, you know, give you more capital so that way you can keep recycling it.
So in the capital stack, then let's just say, let's push aside the bridge debt on this acquisition that we're hypothetically talking about.
Mm-hmm.
So let's just say the raise for equity is like $5 million. And then the GPs in the deal, they're bringing in 2.5 million. You got to bring in, they need 2.5 million essentially.
Yep.
So then you go out into your institutional network and you present the deal to these institutions and they say, yeah, we like this. We'll come in as an equity investor in this type of deal. So does the fund actually become typically in this model, does the fund actually become a co-GP, or is that kind of case by case on how it's structured?
Yes, case by case on how it's structured. Normally, I like to structure it as just straight LP and take no GP. However, it's, you know, 3 common models that's going through that I run now. So it's either fund of funds, it's either co-investment, or it's just a traditional LP. And so when a deal comes in, I pretty much already know, you know, what deal is going to work and what deal won't work. You know, the number one problem that I see today is that the equity check is not big enough. And so when the equity check is not big enough, then I have to try to make it work. But if the equity check hits the $5 million mark, okay, we can make that work. And then from there, it's just as simple as, you know, seeing what the sponsor has and issuing a term sheet. So the thing is, I issue the term sheets once we take it through the due diligence process, the pre-due diligence or tabletop due diligence, then we can issue a term sheet. Once I issue a term sheet, it's pretty much, that's what the terms are going to be. And then from there, we go and take it to run it down the chops. What is the word I'm looking for? It's when you bring people together. Investment committee. So we take it to the investment committee, and the investment committee will be either the, you know, 1 or 2 institutions that we're going to, you know, partner with on this deal. And then from there, everything pretty much checks out by the time it gets there. And it's just all right, this deal looks good. Send it out.
And so on something like this, so the GPs of this deal, they're typically, these institutions want to do $5 million plus deals. Is that typical? 2.5 is probably a little small for most of them.
Yeah, $5 million is the minimum check size.
Okay, so which, you know, so it's a $20 million project or $25 million acquisition, and yeah, so it's got to be a decent sized project. So so these institutional their funds, they're looking for a certain return, right? That's all they care about is their return. They don't really want to get. So do they usually want like a preferred return? And then, you know, how does usually what kind of gets them excited in a deal to like where they're like, yes, we like this deal. We'll sign on the line.
Yeah. So it depends on the institution. So some institutions are risk averse, meaning that they don't like to take on risk because more risk means a greater chance at them losing their capital, where, you know, they want to preserve it. So a lot of institutions want to preserve capital. If you can show how you're going to preserve the capital and not lose it, that's okay. And the return can vary, you know, as long as you don't lose the principal. That's the biggest thing. Principal is more important, because if you lose principal, then you have to make up for the principal that you lost and then generate a return on the loss. And it's a never ending cycle. So the returns depend on the deal. So I would say institutional capital, like Class A assets, because those are the less, you know, the least, those assets have the least amount of risk. However, you know, they generate the least returns. You know, they don't cash flow as well as other properties. But, you know, if you put money into a Class A asset, 9 times out of 10, it's going to hold its value. And, you know, when the market fluctuates, it's not going to fluctuate as much. And so they like those types of assets. Then there's institutions like hedge funds and and public REITs that like to generate a better return on their capital because they know that, A class is cool, but how can we do A class and still generate a lot of upside potential without taking a lot of risk? So the best thing to do is like protect the downside risk and let the upside take care of itself. So the returns for let's say a life insurance company, that's going to be low. That's going to start around 4-6. I would say 4-6 to 10%. That's the returns you'll probably generate from them. For REITs and things like that, it'll go probably between 11 to mid-teen IRRs. And then for hedge funds and things like that, they're going to go above 15%. They're looking to achieve 20% on the money. So if you have a heavy value add, if you have a big opportunistic project or something that needs a turnaround, hedge funds will probably be the way to go because they like to be in and out and they can give you the money that you need to get the project done. And then, once the project turns around, it has to be hedge funds work like this. It has to churn. The more they churn the capital, the more they can make returns on the money. So hedge funds are going to be about 20%. Public REITs are going to be anywhere from low double-digit IRs to mid-teen IRs. And then life insurance companies are going to be under 10%.
Wow, that's pretty amazing. That's cool. And so are most of the projects you're doing, you're not doing major like ground up construction. You're usually just doing value add multifamily. Is that kind of the sweet spot?
Yeah. So I do construction, but anytime construction comes in, I'm going to broker it out. And the reason being is because I look at construction as it's like the startup of real estate investing, like you have to take it from the ground up. And if you've done it before, then that's cool. But, I don't like holding construction, doing construction deals because I feel like it's super risky. So value add and class A is like the real sweet spot. If I can get class A, if you're a class A sponsor and you're doing class A deals, let's do it because, it's an unlimited amount of capital for class A deals. There's an unlimited amount of capital for ground up deals, but I just,
stay in your lane.
Yeah, that's it.
So this is so what do you look for when a sponsor calls or you get introduced to a sponsor and they got a deal? How do you analyze the deal really quick? I mean, obviously, is it like kind of knowing their track record is probably like the number one thing. If this is their first deal, it's a little bit harder to sell. How do you vet the sponsors really quickly and figure out if this deal is going to be worth you looking at?
Yeah. So I don't pull out a model. I don't do anything. It's just 5 data points that I look at. I look at, first thing is how many units. Second thing is the market cap rate. Third thing is the current NOI. Fourth thing is the pro forma NOI. Fifth thing is sources and uses. And then the last one, which is a bonus, is the exit strategy. If you can give me current NOI, sources and uses, and exit strategy, I can determine if it's a good deal for us or not. And then from there, I look at the sponsor. And the number one question I ask is, what's the number one way we can lose our money? And what have we done to mitigate it?
Cool. That's great. And then, so once the deal looks good and you give it the scratch and sniff test, okay, this looks good. You vet the sponsor. Now you probably in your mind, you have the Rolodex of the, 2 or 3 different funds or, institutions that you want to bring it to that are most likely to do that type of deal based on risk and returns. And then you have built relationships with these institutions and you know who to take it to because they've got money and they got to put it to work. So they if you bring them good deals, they end up liking you, and it becomes easier for you probably because now you've proven that you can find and source these great deals. Is that kind of like how you build your name in this space that you're in?
Yep, that is 100% correct. Most people can say what they can do, but it's basically show me what you can do. A lot of people can build a pitch deck and say we're going to do this, this, and this. But what happens when your plan doesn't go as planned? What happens when, you can't find sponsors or you can't source deals the way you thought you would be able to source deals? That's, a pitch deck is one thing, but really doing it and bringing opportunities day in and day out. Here's another opportunity. Here's another opportunity. That is exactly how you build your name up.
And then because you're bringing in like 5 million and the GPs only raise say 2 or 3 million, because you're bringing 5 million in one swoop, you can get higher returns than the mom and pop type of investors in theory, right? That are putting in the 100 grand at a time, because you're bringing a lot more value to the equation.
Yeah, I would say in theory, yes. But if the deal is going to generate 8%, 8% preferred, it's the same return, just on a bigger level. So if I'm bringing 5 million, I'm making 8% on 5 million. If mom and pop is bringing 100,000, they're making 8% on 100,000. So the return is the same, but the amount that you get back is just different because it's, in direct proportion to the amount that you invest. And so one thing that is also beneficial when you bring in a lot of funds is that you can minimize the amount of fees that you have to pay on the capital. So whereas if they were going to charge a 2% acquisition fee, maybe because we're bringing 5 million, they'll charge us half a basis point or 0.5% acquisition fee and no asset management fee. So those is where, you can kind of save because you're bringing in a larger check.
And that's where you can make some money too, as you're putting the deal together, right? So you're getting paid some of that, I guess, in your structure. I'm just wondering, in theory, how do you get paid on this is what you're doing?
That is a great question. A lot of people don't ask that question. How do I get paid? So I get paid, I'm an LP. So I get paid directly so on the fund model, it's the same thing. You have GPs and LPs, or you have a co-investment fund. So in this case, I structure funds as co-investment between my group and the institutions. And then once we structure that fund, then I take that money and I lend it out or invest it with the sponsor. And then in that transaction, I'm just the LP. So the sponsor pays the fund and then the fund pays me. So I get paid because I structured the fund as a co-investment fund with the institutions. And then the sponsor just pays the LP.
So that's kind of cool too, because you're paid not as it's not an active transaction for you potentially. So you can build in a fee up front too, but you can also just be the LP where you're getting you're just a passive investor. You just structured the deal that way.
Correct. And that's the number one reason I wanted to shift this way, is because the number one game is to generate passive income. And I realized that when we raise capital from investors, they generate the most passive income. So I'm like, why not just become a passive investor, allocate the funds, and generate passive income? I mean, there's still a lot of active work on my end, but eventually, it's going to not be as tedious.
So this institution that puts up the 5 million is essentially is an LP in your fund of funds.
Correct.
And is an LP. And then you're just making your fee is a spread essentially for putting the deal together. And so you're paid distributions and then equity gain at the end.
Correct.
So that's so smart. God, I love this. This is why I love doing these. This is why I love doing these interviews. Gosh darn it. Learn something new every day. That's the beauty of real estate. You can continue to learn and you go, wait, what have I been doing wrong for the last 10 years? There's a lot better ways to do things. And love this model. And it's really smart. Gosh.
Appreciate it, man.
Yeah, that's good. So and then you also unlike, let's just say you'll do the same model for senior debt for bridge debt sometimes. Is that accurate? What do you do the most of, or just kind of case by case, just whatever comes your way that looks good, that seems to be a deal? Or do you do a lot of syndication of these loans as well?
Yeah. So on these loans, I only do syndication of the loan when it looks like a good asset that I want to hold, And so most of the loans are going to be brokered out, most of them. And the reason they're going to be brokered out is because, some of them, they just have a high turnaround. They want to do bridge debt. And then some of the stuff is it gets kind of, jumbled up. But most of it is bridge debt. Another portion of it is long-term debt. And I've come up with a product that can compete with, Freddie and Fannie on interest rates, because most people go to Freddie and Fannie because, interest rates are the best and they will
non-recourse.
Non-recourse. And they'll allow sponsors who don't have a lot of experience still be able to borrow, And so I've come up with a product that can compete with them. So we're looking to still, go and attract long-term deals. Right now we're doing short-term. So to answer your question, we're doing short-term bridge. That's the bread and butter. That's where we hold all of our loans at. If I'm going to syndicate a loan, it's going to be a short-term bridge where I can turn it around.
what's your appetite for that? Like thresholds, loan to cost, and what are you looking for when you're underwriting these deals?
Yeah. So loan to cost is going to be about 75%. I can go up to 85%, but if I do 85%, that's going to be a senior stretch. And it's going to be, I'll stop at the senior at 75 and then do a mezzanine loan or a pref to get it up to 85. But for the senior bridge debt, it's going to stop at 75%. Debt service coverage ratio needs to be at least 1.15. Depending on the deal, it can go down to 1.0. It needs to be in the Southeast. It can be nationwide. I haven't seen a deal work in California or New York yet. And what am I missing here? Interest rate is going to be market competitive. It's going to be based off of the 10-year treasury with some type of spread in it. And that spread depends on the risk of the deal. So if it's a super risky deal, then your interest rate is going to start around 6%, maybe 7%. And if it's not as risky, it'll probably start around 5% and go from there.
So you basically put the deal together, it gets funded, and then you, the institution that funds the deal, then do they take care of the servicing and everything, or you outsource the servicing but manage it?
Yeah. So if I broker it out, then the institutions just take care of the servicing themselves. But if I put this together and I do a syndicated senior debt position or a fractionalized first trust deed, then we're going to service it. I'm going to manage the servicer and everybody's going to get paid. And so how it will work is, I'm being super open right now, but how it will work is let's say my cost of capital is 4%. And I lend that money out at 4.25 or 4.5. Once the money comes in, the 0.5 comes, the servicer will send me 0.5 and the servicer will send the institution 4.0%.
So you're making a spread for 12 to 24 months typically.
Correct.
Yeah.
And origination points.
Yeah, that's good. That's a good model too. And so when do you broker versus when do you syndicate those type of deals?
Yeah. New construction, brokering it out. If it's a deal and it's already cash flowing, I'm going to syndicate it.
And what kind of loan size is that? Minimum 5 million too?
Yeah. So my typical loan size is going to be anywhere between 15 to 100 million, but I'm working on trying to lower it down to $1 million. I just got to work out a few kinks to get it lower to $1 million so I can accommodate a lot more people. You're
providing a lot of value here. Let's kind of rewind. And so what were you doing before multifamily? Before you got your first syndication deal where you didn't raise any money? Before that?
Yeah. So before that, I opened 3 businesses and it was all to get into real estate. So my first business was social media marketing. And that was my first ever business. And that business failed. I had like the office space downtown. If you came in, you would think that we were doing a lot of business in that office. It had a receptionist, everything looked really good, but we weren't making money. We were draining money month after month after month. And I was like, if we don't get any clients, we look good, but we're going to fail. And that's exactly what happened. So I pivoted from that business after it failed to opening up a consumer electronics company where I was selling the hoverboards that came out back in 2016, I think. Or 15, the hoverboards came out. I was selling those. It did really good. But once, the press started painting them as, they were blowing up and stuff like that, then import, export, at customs, they started holding them longer and things like that. So then it became too much of a headache, closed that business down and then went all in on real estate, which is what I was trying to do anyway. I just didn't realize that I didn't need as much capital to get into real estate. I just thought you needed a lot of capital to get started.
And so you really kind of taught the lending business yourself. How did you figure all this out? It's pretty interesting.
Oh yeah. So I met a guy. He was a ex Goldman Sachs banker. And I'm like, dude, show me something, show me the game, because he was like, he asked me a question. He was like, how does one street control the whole world? And I was like, what street are you talking about? He's like, Wall Street. That street controls everything that goes on in the world. And how? It's like, I guess it's the money, the capital. He was like, correct. Capital is what controls everything. And so if you figure out how to get people what they need the most, which is capital, then you'll always be in business. And even when an economy goes up and down, people still need capital. And even when, the economy is down, you can still give them capital, but the interest rate is going to be higher. So you make more money. And when the economy is great, you're still going to give them capital, but it's going to be interest rate is lower. So you make less money. But either way it go, you're going to make money. You just got to figure out how capital works and then make it work for you. And then I'm like, okay, teach me. So then he started teaching me, step by step, go research this, go do this, go do this. And then after a while, I got it. And then after that, I was teaching myself every night on the computer. How do you do this? How do you model? And modeling, I just kept doing it over and over and over. I didn't know how to do it at first, but then you keep doing it so much, you keep looking at it, and then eventually you get it. These numbers work. And so now I just think in numbers. You tell me a number, put it in there. Okay, we can do that. But, most people think in pictures. This looks nice. No, I don't care about the picture. I care about the number. Does it make money? If it makes money, let's do it. If it doesn't, I don't think I want to do it, And so, yeah, that's how I came about it.
Yeah. Okay. How about, why don't you give us a little, you don't have to give us specifics, but on a deal you've done, like walk us through like a cool project you funded or you brought in equity that you were pretty proud of. You don't have to give the specifics, just kind of like a high level story of a deal that you put together that you're like, yeah, this was a really good deal. It was a win-win for everybody.
Yeah. So I'll give you a story of a deal in Houston, Texas. It's a $50 million deal. The sponsor needed a full stack. And so when I say full stack, they needed senior debt and they needed equity. So I couldn't bring the equity on this deal, but what I could do was bring the senior debt and I could bring the pref equity. And the difference between pref and common is pref acts like a loan, but it's just not a loan unless you structure it as a mezzanine. Then unless you put a lien on the property, then it becomes mezzanine. But pref is just like a mezzanine loan without a lien. And so they needed a full stack. I couldn't do the full stack. So I brought the senior loan in and I brought the pref in. And then they already had the equity. They just didn't realize that they didn't have to bring as much, So I was able to get the stack up to 90%, which is wow, but it was a decent sized property. It was an A-class property. So I was able to get the capital stack up to 90%. I was able to bring senior loan at 65%, bring a mezz loan to bring it up to 90%. And the sponsor only had to bring in 10% equity. And in that case, the property still cash flowed. It still hit the 1.15 debt service coverage ratio with the mezzanine. With the pref equity piece on there and the senior loan. And the sponsor still was able to give investors their preferred return. And the reason I like this deal is because the sponsor came in and he was just like, I just need a 75-25. I need 75% debt and we'll raise 25% equity. And I said, well, maybe you should consider doing something different, play with the capital stack a little bit, put some layers in there, see what this looks like. And he was opposed to it at first, but then after I broke it down on the spreadsheet, showed him the numbers, showed him the returns, he was like, okay, we can make this work, And then it goes from not being aware that you could do it to we're doing this and it works. And the deal still, it's still going. That's the best part about it.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau Eckstein, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. So these pref equity lenders, they're looking usually they have their own box, right? They want to do usually 10 million plus loan size, at least, right? 5-10 million minimum loan size. Mm-hmm. And actually, so when they come in, they're in a pref deal. There's no recorded lien. Mm-hmm. They're almost like an LP. In a mm-hmm. sense, right?
Yep.
But how do they protect their interest in a pref deal? They have any, like in a mezz deal, aren't they kind of written into the LLC documents? I think. Yeah.
So in the mezz deal, they're written to the LLC documents and they put a lien on the property. So they're sitting behind the senior lender. In a pref deal, the owners are pledging their equity interest in the partnership. So basically they're saying, if things don't go right, you can take over this partnership and ultimately take over the deal and run it. And so that's where the pref equity is protected by the partnership interest. Whereas in the mezz loan, the lender is protected by a lien position.
And a lot of the when we were talking about the how we're doing fund to fund and bringing in equity from these institutional investors, those institutional investors, some of them also do these pref deals too, right?
Correct. Some of them do the pref deals, but then you have to present it in tranches, and that's just different layers. Tranches is layers, so you have to present it in different layers. So if, let's say, how we think about it on the back end is, if we have a stack that's 85%, right? And we say, we're told the sponsor will give you 85% of the capital. In the back office, what we do is take that and break it down into layers where, we might stop at the first 50% and says, this layer is the lowest layer, which takes on the lowest risk. Then we go up to 75%. This layer is, and those returns for each layer is different, but, the lender will pick which layer they want to invest in, and they can do a mixture of, we're going to take up the whole 50% layer, and then we want a piece of the pref layer as well to kind of juice the returns.
And going back to this deal, so that sponsor, at first he's like, okay, I'm going to bring in 25% of costs on this deal. Mm-hmm. But when you showed him, hey, what's your IRR? You're getting a better return by bringing this pref into the capital stack. Essentially, you're leveraging more, even though it's the cost of this capital is more than the senior debt. It's mm-hmm. a lot less than what you're paying your LPs, essentially.
Correct.
And your IRR is going from X to X because of this stack, if this deal executes the way it should execute.
Yes, that is it. And when I realized that the number, it's crazy how if you look at a whole layer and say, I'll give you 4% for 100% of this deal, you would think, well, most of this deal can only make is 4%. But if you start breaking those layers down and offering different interest rates at different layers, how you can make the returns go up and still minimize risk for investors. That blew my mind, because I'm like, 4% for the whole thing. But if I break it down, you get higher returns. How does it work? But I suggest, people try it, take some layers and just say, I'm going to do this one at 8%, this one at 6%, this one at 4%. And then you'll come up with a weighted average cost of capital. And then you'll see, okay, my weighted average cost of capital is 6%. But when you look into it, I have 8%, 6%, and 4% at different layers. And then it just blows your mind. It's just like, that's crazy.
So you've been you're a pretty young guy. So you've been an entrepreneur most of your life, it seems like.
Yeah, my entire life, I've been an entrepreneur. I like to consider it the wild, wild west since forever. I went to college, got out of college, and still kept going. But I realized that I wanted to be an entrepreneur in college my sophomore year.
Did you come from a family of entrepreneurs, or were they just working class people and you're like, there's got to be a better way?
Yeah, so half and half. So half of my family was working class, and then the other half was entrepreneurs. My granddad was an entrepreneur, but he just couldn't seem to get it right. He was just, he was hard working. He had everything, but he just couldn't seem how to make the money multiply. And I'm like, okay, that's good, but we got to figure out how to make it multiply. My mom is a hardworking lady. She's been working, and that's what she loves to do. So hats off to her, but she's always instilled in me, like, you have to go to school, get good grades, and then get out and get a job. And then I went to school, got good grades, found out that good grades is not going to get me paid. It will give me paid, but not how much, it's not going to give me what I want. I really want freedom. I want to be able to put stuff out and create stuff and all of that. Because entrepreneurship is really about freedom and creating and controlling your narrative. A lot of people associate money with it, but it's not really about money. It's about you figuring out something you want to do and then putting it out into the world, and then bam, it works. It's real and people accept it. And so that's what it's about. But my mom, told me to get a good job, go to school, get a good job, all that. So I went to school, found out I was going to school to be a corporate lawyer. I wanted to be a corporate attorney. I wanted to get out and do mergers and acquisitions and, do that. But then started interviewing corporate attorneys in school. A lot of them told me, if this is not what you want to do, find out what you really want to do, because this is not it. And then I realized, dug deep down inside, said entrepreneurship is the way. When I got out of school, my family was like, go and get a job because you went and got a 4-year degree. So you need to get out and get a job. I said, I'm not doing that. Whole family was like, I was banned from the family for a while. And then they started realizing that I was on to something. I wasn't, I was making money. I was taking care of myself, and I didn't have a job. And then they were like, I guess this can work. And then, eventually come back around. But it's sometimes you got to be willing to go against the crowd if you feel it deep down in your heart.
Yeah, that's awesome. Very cool. And what do you do on a daily basis for personal development? I always ask this question.
Yeah. I work out 2 times a day and I read 10 pages.
Cool. So it sounds almost like the 75 hard challenge, Andy Friselis.
That is it. That's what I do. I do that program.
Okay, good. I've done it too. I did it for the 75. It was great. My second workout was always just a walk outside because I sit in my home office all day. But yeah, the 75 hard, it's almost easier. It is easier to be disciplined in life. There's no question in my mind now. Like I've always been my own boss too. And if you're not disciplined, you shouldn't be your own boss. You got to be extremely disciplined if you want to be an entrepreneur, in certain ways, but you also have the freedom, but you also need that discipline. It's kind of like counterintuitive almost, but it's true. It's like, but that's amazing. This was a really, really cool interview. I got a lot out of it and made me think about my lending business and how, I know what can be done and just thinking outside the box. And, it's true. Wall Street controls the world, the money, control the money flow, right? And just be kind of like you're kind of like the orchestrator of the money. There you go. Money here, money goes, and make a little bit on top. And that's where, if you really look at these syndicators, they make the good syndicators can make a lot of money. Yeah. And what they do is OPM other people's money. And it's the same thing. You're just working at kind of a different part of the transaction, which is probably the better part, actually, because you don't have to run the multifamily apartment complex. It's you get to kind of facilitate the capital stack is what you do. So very fun interview. Where can people find you? Where's the best place for anybody out there to find you?
Yeah, you can find me on Instagram. You can find me on LinkedIn, Roddrick Jones, ROD as in dog, D as in dog, RICK Jones, or you can shoot me a text 770-421-5160. And if you can't find me there, you can go to apartycapitalmarkets.com and you can find me there.
Awesome. All right, everybody. I hope you enjoyed this episode. We talked about the capital stack and, just think about how money works, guys. That's the key. How money works, getting the right partners. If you're syndicating deals, there's no I in team. It's a team sport in commercial real estate versus the single family space. So anyways, hope you enjoyed. Please like and subscribe, and we'll see you on the next episode.